What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, babies? It's your partners. We back in the saddle, always looking better than you. So while you can, take the damn picture as we lean back and you like some chicken. You see it, Cliff? What it do, baby? What's going on, baby?
Hey
What's
man,
going on?
doing good, man. Another week, baby. You already know.
Hey, man. More importantly, did we get the bag?
Always getting that bad, boy.
We got the bag, y'all. We got the bag every day. You know your partner. I got that bag. I got another one coming on Monday too, y'all. You see it. It's the time. But guys, man, thank you. Welcome to another session of the Real Estate Trending Friday. We talk all things real estate. Cliff and your partner, man. Guys, we're gonna jump right into it. Guys. Cliff, man, the current market analysis, man. What you seeing, Doc? What you seeing?
Right now, we seeing the market's still slowing down big time.
Yeah.
Big time. The Fed just raised rates, so you seeing high interest rates right now. So
Show enough.
the real estate market is dead. I mean, it's done right now. This time of year, it's already slow. Combined with the interest rate, it basically is. I would say the market is down almost 80-90%.
Ooh, in what spec? Are you talking about the refinances, sales, or both?
I would say in refinances it's down 90%. In sales, you're probably down 60%.
Woo! So you're looking at a 90% reduction or back and a 60% reduction. That's a huge reduction. How have investors countered that type of pullback?
So they've been the rental market is because there's no one's buying, they're having to rent. So rents are going high. There's only
Wow.
so much shelter, and there's no more building. So there's nothing new coming on the market.
Mm.
So the rents are going up. This is why it's always good to have a rental portfolio because even when sales go down, rents still stay strong.
Every day, all day, baby. Yes, sir. Yes,
So
sir,
it's
man.
the market right now, but it's a good opportunity to buy. Right now, in the next couple months, is a good opportunity to buy.
Yes, sir, it is. But I think this market is going to bring, it's going to sift out the pretendo investors and give great opportunities to those sophisticated investors that know how to structure deals the proper way. The key word there is structure. Okay, in this economy, that's where you can realistically find those diamonds in the rough. Those diamonds in the rough become more easier to find, whether it be in a mid tier area, which is what we kind of focus on the major metropolitan areas. Now, I still believe that the major metropolitan areas are probably the hardest areas to find those diamonds in the rough, but you can find them. Would you agree, Cliff?
Oh yeah. But the good news is that they're harder to find. But if you do find them, it's nice to buy and hold.
For sure. Now, me and Cliff are having a very interesting discussion offline about what was going on in the market. It was a great, reasonable discussions. Me and Cliff don't agree all the time, guys. That's not really healthy. That's not really healthy at all. And so we would have a discussion over CPI, Consumer Price Index, and the PPI, Producer Price Index. And he made a profound type of observation, he and I didn't agree. So we're going to invite you guys into that discussion before we dive into the the actual topic today. That's going to be really good. So Cliff, go ahead, man. What do you think about the CPI?
So, all right. So right now, the CPI is about 7.7. So we're up 7% in prices from last year on average. So that means food prices are up, rental car prices, everything, all consumer goods. You go to Walmart, everything is up, right?
Yes.
But over the last 3 months, we've seen inflation rates start coming down. So my argument, right, that me and Dale was going back over is the rate of change the fact that you're starting to see a reduction in prices is
You
the
see that?
first sign, right? It's the
Mhm.
first sign that the market is slowing enough that inflation's coming down.
And this was my counter. I said, I can see what you mean if you look at just the CPI.
Right.
I can see that. But then what you actually have to look at is if the inflation is going down, why would the Fed do anything else at all? Number one. And number two, why are prices from a PPI still going up? When I say PPI, price producer index, what that means is it's still costing the consumer more money to go out and buy the same goods. My conclusion was this here is the consumers have adjusted their lifestyle to where they can say, okay, I may not be able to fill up my tank this week. So I'm gonna give a half of a tank. So the demand has went down because consumers have adjusted their actions. It's not due to what the Fed is doing. The consumers have done that. But what I'm saying is you're still seeing a spike in the cost of goods. Cliff, would you agree or disagree?
Well, the cost of goods month to month is low or flat. Now, you're right in this in what you're talking about with the consumer.
Uh-huh.
But
Uh-huh.
what I think is happening is an adjustment. Prices are not going down. So
Not no.
let me explain that. Right
Okay.
now, I go to McDonald's, give me a cheeseburger, whatever. It's ten
Yeah.
dollars. It's high.
Yeah.
Last year it used to be $9. The year before that
Yeah.
was
Yeah.
about
Yeah.
8.
Yeah.
What I'm saying is it's $10 now,
Mm-hmm.
but it's gonna stay $10. It's
Mm.
not gonna go down. I'm saying that's the new reality. We've already printed the money. It's already out there. It's done. So that inflated price has just stopped. That's it. I'm not saying it's going to come down. I think like the cost of all the goods is going to stay where it is. It's just not going to come down, but it's not going to go up either. We've reached stability.
Well, and here's my counter to that. I can receive that what he's saying. My counter would be this here is, and I'm gonna use a bill, the Inflation Reduction Act, which means really the Inflation Production Act, what that really is. And
Right.
and what I mean by that is those dollars had not hit the market yet. They won't hit the market until 2023. So in an effort for the government to manufacture cash flow because we're in a debtor nation, what's happening is I am saying that the cost of goods and services are going to go up even more because of those dollars have not been flooded into the system yet because the government was trying to manufacture cash flow. So that's why I'm saying in 2023, it's going to get even worse. It's going to get worse because number one, from a real estate standpoint, consumers are not going to want to buy any more properties at all. They can't. So now you have a lot of, there's still some buying going on, guys, because you can buy down your rates. In other words, if I'm selling a property for $100,000 and there's a buyer and a seller agent, so to speak, the agents can credit their a portion of their commission toward the buy down of the rate. So it gives it more incentive for the, what happened? Well, anyways, here we go. So it just took us off the screen. Oh well, I don't know what's going on, guys, but hey, I'll get us back. Here we go. There we go. What's happening is this here is the consumers they can buy down their rate because the realtors can say I give a portion of my commission toward the buy down their rate, so it incentivizes the consumer to go forward with the loan. A friend of mine did that for his VA loan, which was great. What I'm saying is that's going to stop because people are not going to want to continue to buy because the rates are going to get so high. I'm saying it's going to get between 13 and 16%. And I also spoke to a
Mm.
colleague of mine who speaking to bank CEOs and banks. The banks are coming to conclusion from I call them Class A banks, the Big Five to Class B banks. They are coming to the conclusion that's going to be 13, 60%. Easy,
Mm.
easy, because of the fact that people people are going to continue to adjust their actions because it's painful a little bit right now. But just wait, man. That same milk is going to cost a lot more money. It's going to cost a lot more money. You agree, Cliff? You disagree?
I agree in a couple of places, right? So
Okay.
it's possible from what you're saying, like there's more money supposed to come in. The government spent a
Yes.
bunch of money,
Mm-hmm.
right?
Mm-hmm.
But
Mm-hmm.
the amount of money they have left to spend is way less than the what has caused the bulk of the inflation to this point. We spent trillions. What we have left is it's got a couple hundred billion, which is going to contribute, but it's not going to, in my perspective, right? What I'm trying to say is it's not going to inflate as much because you have to understand the Fed's okay with 3% inflation. They're okay with almost 4%. That's not much to them. They can bring 4% down to 2%. That's not much. So what you're saying is right. It may inflate a little bit, but I don't think it's going to stop the trend that we're currently on to be able to keep the reductions. Because if you look at the table,
Mm-hmm.
what are the main drivers that are still going up? Everything else has been going down. Some things have been going down for 6 months, 7 months. If you look at the chart, so 7 months in a row, prices have been coming down in certain sectors. There's only a couple sectors that are keeping the prices high. Rent prices are so high that, according to the Fed, it's going to take a year to bring them down, or at least flatline them, right? Where they don't just keep going. The second one is services,
Mm-hmm.
right? Because unemployment is still low, right? That's why
Mm-hmm. Mm-hmm.
if you look at the chart, services has still up. It went up month over month. So
Yeah.
the cost to your employees is still going up because we don't have enough of employees. But what do you see from Meta? What do you see from Redfin? What are you about to hear from Zillow? They're about to go through firings. They're
Meta's
gonna
already laid off 11,000 people. Redfin laid off
that
about 13,000 people. Zillow's
that's what
laying off about 16,000.
that's what I'm saying because there's demand. They have demand destruction has already been created. The money flow has stopped because of interest rates, and so the services that's going up will start peaking as they start letting more people go. This is just the beginning. For the next several months, you're going to see them start letting people go to start
Yeah.
adjusting that services down.
Yeah. Yep. But I
So
would say this here
mhm.
is if you look at this guy's the CPI right here. This is what the number that they're using. This side here.
Right.
But if you look at all of this here, 11.4, and I'm not going to scroll way up to the top, guys. It's talking about food, housing, stuff like that. It's for they divide it out into segments of what's causing the inflation. 11.4 was in August. 11.2, 10.9. You see that. 13.5, 13.0, 12.4. I'm using the last three. 8.0, 8.5, 8.6. So this section's going up. So 32.9, 23.8, 19, and 17. So you're seeing all this volatility. This is before new dollars have actually came into the segment. For the and I believe the Inflation Reduction Act was like I think $2 trillion. That's with a T. You ain't seen those dollars yet. You're not going to see any type of. I think Patrick Davis said this best. He said the what do you call it? The whenever you lay off people, the employment report, what it was called. Um, you won't see those numbers, the real numbers, until next year. The real numbers. Next year is going to you're going to see the real numbers because there's going to be new dollars, fake dollars coming into place. It's going to be chasing the same goods and services, and then what will happen is then you begin to see where it's at. I believe this is where me and Cliff disagree, guys, and it's okay to disagree, guys. We are right. We ain't tripping. I believe, guys, the worst is yet to come. And Cliff believes that that may be the issue, but Cliff may say we may also be at the bottom as well.
Yeah,
Correct?
that's what I'm thinking, that we're close to the bottom. We may have some little bit more to go,
Sure.
but I'm also saying we may stay at that bottom a little bit. I'm just trying to say we're close or at the bottom. I think this is the worst we're going to see, but we may hold here for another year. And then building out of that may be a whole nother year. But I'm thinking that's why you saw why if you pay attention to the stock market, it boomed yesterday. Why? The CPI numbers came out and it showed month over month trending sideways. So if you watch charts and things like that, what you'll see is you see stock markets that go up, and then sometimes they hit a range before they hit a breakout. So we're either going to break out this way or break out down. I think the breakout is going to be when the Fed goes. I think next meeting they're going to do 0.5.
Okay.
And then the meeting after that, they're going to pause.
That one I don't know, because the reason why the stock market is going up is because the federal government is buying their own bonds back. That's the only reason why. That's the only reason why. Is there's no other countries buying the debt. They're buying their own bonds. They're expanding the balance sheet. It's fake success. I've never met a company that creates a good service and then puts it on the market and buys it back themselves. That didn't make any sense.
So I agree with you, but what I'm saying is the flow of money. Like, put it this way, Dale. Put it this way. And then if a flow of money came to you, let's say you get 10 million.
Yeah, I got you.
Right? Is now, and it, like, if they gave you 10 million, you're probably gonna sit on it.
Hell no.
You're gonna sit on it.
No, I'm gonna put that thing behind hard assets, man. No, sir.
Okay, yeah, you may, but I'm saying that, okay, let's say the average person.
I got you.
Right now, the average person is not spending as much money, right?
Yes, because
So
they can't.
even if they got a raise, they're not spending as much as they were before because prices right now are still somewhat high.
Yes.
And anything that's debt related is costs are too high. That's why, for example, real estate is a good example.
Sure.
The cost, the people who want to buy, or I'm sorry, the demand for that product has basically halted. The prices are too high. They're too far out of range, so the prices have to come down to meet it. Sure. I'm saying once they meet, you will have that floor, and right now that floor is coming because the interest rate are going to stay stagnant. So, for example, we just kept talking about the banks and the fact that they are changing their terms, right? Interest rates are going up. They're going from 70% to 60%.
Mm-hmm.
That will stop. That will stay where we are currently because the Fed will stay their interest rates. They've done the fastest increases in interest rates in history. At some point, they're going to have to stall. They're going to have to say, hey, we're saying month over month change. Month over month inflation rate is flat. Mm-hmm. Maybe we've put enough of demand destruction in the economy that we need to hold to see if this continues at its current interest rate.
Maybe, again, I'm hoping that Cliff is right. But from what I'm seeing concerning what the Fed is doing, federal, as far as them buying back their own bonds, they're expanding the balance sheet. There's a lot of high regulations in the areas to where that's how we generate a lot of our cash flow as a country. Energy, oil and gas, real estate as well. So you have that going on as well. They've kind of curtailed the expansion of our economy to where they're wanting to manufacture the type of cash flow because they're purposely restricting the cash flow that's needed. And so because of those actions, you see a reaction to that when it comes to consumers. Cost of goods go higher, cost of services go higher. They say, I'm not spending no money at all. And that's the worst thing to happen in a debtor nation is for money to stop flowing. You want generic cash flow of a good and service being produced, and the consumer cannot agree to buy the good and service at said price point. That's not really happening at a higher level at all. What's happening is the goods and services have gone up. The consumer says, I'm not willing to really pay that on an ongoing basis. So I'm going to begin to change my actions, say, I'm not going to buy this good or service, because it costs too much. I'm going to hold my dollars in, and now money has been stagnated. That's why you get stagflation from. So it's stagnant now. No money is really flowing at all, period. So the government steps in and says, okay, we'll just manufacture it. But you're trying to manufacture cash flow, I think, in the wrong way because you are curtailing the environment, our economy, with all these high regulations, which is when you try to manufacture cash flow, Who steps in? That old buddy called inflation, which is a stealth tax. So not only is it costing the consumer more on goods and services, they're also getting hit from a stealth standpoint with an inflation stealth tax. That's a death knell.
Mm.
That's
I,
a
I
death
see.
knell.
No, I see what you're saying,
Mm-hmm.
and I think what their plan really is, and that makes sense
Sure.
because they're just the money is already in the system. They're just curtailing
Yes.
the flow of it, right?
Yes.
They're managing the flow of the money.
Yes.
So
Yes.
since they're doing that and directing it, as you just said,
Yes.
they can't do it forever. They need the money to flow. So at
Thank
some
you.
point, they gonna have to let up because the money not flowing, there's two problems for the people.
Yeah.
One is taxes go down. We don't get as
Yes.
much tax revenue,
Uh-huh.
right?
Mhm.
And which starts killing all the different services that we already have,
Yeah.
right?
Yeah.
So and the second one is with the services, you start
Yeah.
getting unemployment. Unemployment starts creeping up.
That's right.
But that's what they're looking for. They want that destruction. And the reason why, like you said, is to
There
slow
you
it.
go.
They want to
Mhm.
slow it enough to let it up. Because basically what they're doing is I think of the financial system as a balloon. All you're doing is squeezing one end of it. It's just going to the other. It ain't going nowhere. All the other stuff is funny, math, and all that other kind of stuff they doing, right?
Sure.
So instead of just letting the money flow and let prices end up where they end up, they're slowing that inflation rate down.
There
and
you
so
go.
over the next 2 to 3 years, it's going to inflate. They're just going to do it slower.
Here's what I would say,
You
though.
see what I'm saying?
I hear what you're saying, but by doing that, they are infusing more cash, manufacturing that into that. I'm gonna say that's the helium into the balloon, and it's affecting all of the industries. Balloons, when you put too much helium in there, what do? They pop.
Right.
So it has to pop. In order for them to slow it down, they have to stop curtailing the expansion of our economy to the point where they say, okay, we're gonna release the regulations. I'm gonna use energy on natural gas and oil. We're gonna release that. So now all of a sudden capital can then be invested. You open up, you'll say, now producers say, now it's safe for me to actually walk in and say, hey, Cliff, I'll give you X for this service if you pay Y. Cliff says, it makes sense, and now it comes together through the free market. Right now, the free market saying, I really can't really get involved in this at all. And I'll give you an example. With one of our big banks originate loans, and then they sell them on the secondary market, right? What's actually happening is a lot of these banks, what they've done is they have discontinued or suspended or paused a lot of their loan products because the secondary investor does not want to buy the paper. They're saying, I'm going to hold on to my dollars now. I'm going to hold on to it because it didn't make sense for me to do it at all because it's costing me too much money.
But that's because of price stability. They're holding their dollars.
Stability?
Right. But
go ahead.
Yeah, that's what I'm saying. Price stability. But it's hard to do business when you're trying to buy products and 1 week is $10, the next week is $12, the next week is $14. What I'm trying to say is once it goes, I'm looking at it, it went from 10 to 11 to 12, but then it goes to 12 and it stays at $12.
Yeah.
Okay, now I can actually invest
Get back in. Yes, there you go.
Because I know the price of things. Right now, I can't. Both me and you don't know. We arguing over where it's gonna go.
Yeah.
But once we both know, inflation stopped. Interest rate 7%. Now we can invest at that point. Once we know the stability. You see what I'm saying?
That first quarter is going to be very telling.
Yeah.
Very telling, guys. That first quarter, first and second quarter, very telling. I hope Cliff is right. I hope he is. I hope he is. But from what I'm seeing from a government standpoint, they have no intentions of stopping what they're doing. They're going to continue to constrain the market, and this is going to be our biggest areas:
Yeah.
oil and natural gas, and real
Mhm.
estate. That's what I'm kind of seeing, guys. And we'll see.
Yeah, I agree.
Go ahead, Doc.
Now I'm just
What's
saying
it?
I agree. They purposely killed the real estate market because even if think about this, if you own real estate, you're still
Yeah,
up.
yeah,
You still are up. Even though prices came down 100,000, they were up 200,000 from 2 years
sure,
ago.
sure. It was fake success. And
Right.
that was fake success,
Right.
fake. And so now you're beginning to see what it's really going to be. That's why I believe that the rates are going to be between 13 to 60%. Because if you look back at, and Patrick went through this in the video that we played last week, he talked about how 6, 7, 8% was where we need to be at. That's where we need to be at, because 2, 3%, y'all, that's gone. That's not going to happen. No matter if it's Trump, DeSantis, it ain't happening. Get that out your head. 6, 8, 9, 10%. That's going to be the benchmark moving forward. But I believe it's going to go from 13 to 16% easily. Easy. And that's going to really hurt the market. You think it was, and right now because Cliff, to refinance out one of our portfolio loans, okay, that we have a portfolio, one of the rates was 10.25%. 10.25
Damn,
at 70% LTV.
that don't make no sense. That don't make
This
no sense.
is an investor loan with 30% of equity there. It's a low risk, 10.25%. FHA is 3.5% put down, right? That's a little more riskier, right? You better
Right.
believe. Math tells me if at 30% equity, this is good. 30% equity, guys, I'm getting 10.25%. At 3.5% down FHA, 13 to 16% is going to be easily what it's going to be, because it's a higher risk.
Right. Yeah, I see what you're saying.
See what I'm saying?
Yeah. That I think that's gonna happen too. I still think it's gonna go up. I just think it's gonna stop pretty
Yeah.
soon. But yeah, you're right.
Hopefully. I hope Cliff right, y'all. I hope Cliff right. Hope he is. But God, we spent 27 minutes talking about, and this is how Cliff and I and Jason, you meet Jason Hanna as well, and James Case and Yvonne Edamende and Jahendra White. This is how we get on the phone line, guys, or whether it be video, and we go through deals just like this. Cliffman said, Dale, I don't know about this GC, man. Well, I think this is great. We go back and forth and we come together with a consensus on what it should be. We welcome in debate. We're not in the echo chamber. Would you agree, Cliff?
Oh yeah, to get different opinions.
Yeah, that's correct, guys. But let's jump into the subject, guys. Thank you so much for your time, guys. Because of where we are in the economy, I think this subject is pivotal. How to use joint venture partnerships to grow your real estate portfolio. Cliff, before we go deep into this thing, man, what is a joint venture partnership? What is that in real estate?
It's basically when two or more people come together in order to do a deal, to buy a business or piece of real estate.
So gotcha. So if that is the case here, Cliff, here we go. Is why would a real estate investor need a joint venture partner?
They bring something to the table. It's money, credit, experience, something along those lines. They bring in something to the table you need.
I agree. And also, guys, a JV investor, because they're bringing more credentials to the table that you may need. It makes the deal more favorable to the lender itself. What happens is this here. That can affect your rate. You can get a better rate, a higher LTV as well, because you can show cash reserves, better credit, better experience. So that's why a JV investor type of scenario may be a beneficial individual, because it makes the deal a lot more appealing to the bank. You agree, Cliff?
Oh yeah. I mean, it's just because the more people you get involved, the more stable that deal is.
There we go, guys. There we go. Let's go to the next question real fast. What are the most important points up front with joint venture partnerships? What do you think, Cliff? What's more valuable to you?
I would say, like, in the agreement, you need to point out the responsibilities of each person.
I agree with that one, because I would not do a handshake agreement.
Oh
I will
yeah.
shake your hand, but if it ain't written, it ain't real at all. It needs to be clear, defined responsibilities on the table so that there's no question. This is when you welcome in that power team member called an asset protection attorney. Keith, where I said it was asset protection attorney, not a real estate attorney, an asset protection attorney. They can structure the JV the right way. Would you agree, Cliff?
Right. Yeah. Yeah. You gotta bring in smart people.
Got to. Let's say, um, what type of JV partner should an investor choose?
Mm.
Mm.
Now, if I'm buying real estate
Mhm.
and I'd probably say somebody who has access to capital and not just a
Mm.
little bit. They have their own capital funding,
Mm.
meaning
Mm.
they're
Mm.
part of a buying group or an investor source. And I had this
Yeah.
before where I had an investor and I had one guy and he actually had 10 or 11 investors who invested with him.
Mm. Mm.
So
Mm.
it made it easy because I
Mm.
had one person to go to.
Oh yeah, yeah, that makes sense. I would say it really depends upon the need of the real estate
Right,
investor.
right,
What
right,
is your need? Once you understand what you actually need, you can probably begin to vet your JV partner. In other words, if credit is an issue, what do you think you need? A joint venture that has credit. If cash is an issue, what do you need? A JV partner that actually has cash. If experience is the issue, you need a JV partner that actually has the experience. To be the person that actually has experience, most likely also has the cash and the credit. If you see what's kind of going on here. So it really
right.
depends on what are you needing? What are you needing? All right. Now here is the $1 million question here, guys. So to the JV partner, which means joint venture, partner couple debt financing with the partnership. What you think, Cliff?
I think it depends.
Mm.
It depends. How is that deal structured? I'm a, I'm a,
Woo!
I'm gonna understand how it's structured. I'll do almost any deal if it's structured right.
Ah, I can agree with that as well. I know for us, when we do JV partnerships, we 99% of the time bring the debt too.
Mm,
We do because it gives us a little bit more control of the deal. To where if the investor does not perform well, we can widen the circle, have a conference call or webinar, and say, okay, what are the logs in the eye? What are the issues? Let's begin to look at what's going on. And
right.
so for us, that's what we kind of looked at, guys. Now, you may not need a debt partner. That's fine. I've done deals before in the past to where to where uh, our cash wasn't needed. We just needed our experience and to show we had actually had cash. We actually needed, and that was fine. We made a nice little fee, and we actually have a minority equity in the deal, and that was fine. It really depends on the need, but for me, I welcome a JV with component. I welcome those type of partnership. That's more appealing to me. It's more appealing to me. Well, guys, update on this here, guys, is here. So now, guys, I may do a live with Cliff like this here, walking you through the course. And I am, like I said before, we're about to scholarship as far as me, 5 people to have the access to the real estate course. I know Cliff has people as well also. He's looking at must be between 3 to 5. We kind of go from there. But guys, it's here. It is here, guys. It is here. It is here. And I think you guys are going to be pleasantly surprised. We do. I'll let you guys know this here. When you log in and begin to look at it, guys, you're going to see some courses say coming soon because there's one course, which is probably going to be one of the most popular courses. I'm going to give you a title: How to Acquire, Renovate, and Sell Your Property in under 90 days. Cliff is doing that one. Cliff is literally walking through Home Depot, walking you through how to price out cost of goods. And that's probably one of the most biggest disciplines in this type of volatile economy that you should actually have. Would you agree, Cliff?
Oh yeah. I mean, it's all about getting the knowledge you need, and so
Yeah, 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 yeah.
what going through and kind of showing you the construction component. You just get good information.
I agree, Gasper. So we want to thank you guys just for your patience in the course. Again, we didn't want to give you guys some jangle egg course. We wanted it to be fruitful, edifying, and you begin to learn some questions as well. And also, you gain access to the VIP from a subscription standpoint, to where every bi-weekly we'll have a call, a webinar to our community VIP members. We tell you, bring your deals, bring them. Let's look at the numbers. And more than ever, guys, you need that wise counsel around you, because as me and Cliff talked about, we talked about the economy for 30 minutes. You know what I'm saying? 30 minutes. That's the type of discussion you need to continue to have when it comes to vetting your deals. More than ever, you need some partnerships. Would you agree, Cliff?
Oh yeah, I mean it's part of it, and so we go into that. I try to give basic information so you have a something to learn from and something you can use. And you're gonna learn two ways. You're gonna learn from the information we provide, and then you're also gonna learn once you actually get started and you have mentors to guide you. That's how you're gonna most likely find success.
Yeah, guys. But guys, that's all we had for today. I hope you enjoyed our discussion up front for 27 minutes on the economy. But this is what we do every day. Is that right, bro? What we do
every day. Every day
we do that, man. And so, matter of fact, after this call, we're gonna get on the phone out with our contractor in Starkville, and we have the same type of conversation with him. And so, it's what we do, guys. Well, man, thank you so much for your time, guys. God bless you. And before you leave, and while you can, take the damn picture for your mama now. All right? Now holla at your partners. Peace. God give thanks. Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Big God, big